Crypto for advisors, impact of the spot Bitcoin ETFs for portfolios. The approval of the spot Bitcoin ETFs constituted a landmark event for the $1.7 trillion digital asset industry. With institutional investors on board, demand for Bitcoin will grow significantly. We've passed the 1-month mark since the spot Bitcoin ETF approvals in the US, and now we have real-world data to review. In less than a month, the spot ETFs are boasting $10 billion of AUM, with inflows reaching $1 billion in one day alone. For context, the spot ETFs must acquire and hold the underlying asset, Bitcoin, of which there will only be 21 million. As the market watches the interest in these ETFs, the conversation naturally includes portfolio construction. How much Bitcoin should I have in my portfolio? Gregory Mall from AMINA Bank looks at different methodologies for including crypto in a portfolio. Marcin Kazmierzak from Redstone Oracles discusses staking and earn products in the Ask an Expert section. Several firms have now submitted spot Ether applications to the SEC. Will they gain approval next? Happy reading. You're reading Crypto for Advisors, CoinDesk's weekly newsletter that unpacks digital assets for financial advisors. Subscribe here to get it every Thursday. US Bitcoin ETF approvals, a game changer for the industry. In a widely publicized decision, the SEC authorized 11 funds to begin trading on January 11. With the approval of the first spot Bitcoin ETFs in the US, investors worldwide are closely monitoring the potential implications on the broader asset class over the short and the medium to long term. Buy the rumor, sell the fact. Bitcoin led a significant rally in cryptocurrencies over the course of 2023 with a 160% price gain. After a scandal-ridden year of 2022, which saw the demise of 3AC, Celsius, FTX, the ink was not dry on the obituaries as Bitcoin staged an impressive comeback. A big driver of the price resurgence was the anticipation of an SEC approval for the first spot Bitcoin ETFs in the US. When BlackRock filed for a Bitcoin ETF on June 15, 2023, Bitcoin jumped by approximately 22% within 1 week. When it became clear that the SEC would not appeal the ruling of the Court of Appeals on October 23, Bitcoin once again surged by 15% within 2 days. While other factors such as the decrease in US yields in Q4 and a recognition of macro tailwinds contributed to the year-end rally, the main catalyst was indeed the spot ETF. The fixation of the asset class around this binary event was always going to come with some risks. A subsequent lack of narrative would, according to the naysayers, lead to a classic buy the rumor sell the fact situation. An entire asset class clinging onto a binary event was the proof that crypto still had a long way to go to become mainstream. While Bitcoin has traded on an upbeat note since the approval, the massive retracement that many technical analysts had predicted has not materialized. Flows into the new funds have been encouraging, with overall inflows of $9.7 billion recorded February 12. Implications for the growth of the asset class in the medium term. The approval of the spot Bitcoin ETFs constituted a landmark event for the $1.7 trillion digital asset industry. With institutional investors on board, demand for Bitcoin will grow significantly. For example, analysts at Galaxy Digital attest to an inflow of $14.4 billion into the spot ETF in the year of its launch, followed by $27 billion in the second year and $39 billion in the third year. The inflows would come primarily through the channels of the asset management sector, which currently does not have access to secure Bitcoin exposure on a large scale. The investments in the billions would also significantly change the value of the cryptocurrency. Such institutional inflows are likely to further cement cryptocurrency's status as an asset class. Liquidity could become more stable overall, and the price of Bitcoin less susceptible to extreme price fluctuations. Furthermore, there are positive secondary effects such as the approval of spot ETFs on additional cryptocurrencies, inflows from VC money into the asset class, and increased acceptance of cryptocurrencies as a payment alternative. The approval of a spot Ether ETF is the next event to watch. Deadline is May 23. How to gain exposure in a balanced multi-asset portfolio. Adding a small crypto allocation to a multi-asset portfolio can enhance returns without affecting the risk profile of the portfolio. Graph 1 shows the increase in efficient frontier by allocating a small proportion of a balanced portfolio to Bitcoin. Graph 1 efficient frontier balanced portfolio with and without Bitcoin allocation. Balanced portfolio consisting of 50% MSCI World AC, 40% Bloomberg Barclay Global Aggregate Index, 10% Bloomberg Commodity Index. Source: AMINA Bank. Start date 1/1/2016 and date 29/12/2023. While most institutional investors agree that cryptocurrencies have a role to play in their portfolio, the question that divides the profession is what is the most efficient way to gain exposure to the asset class. Bitcoin, a basket of coins. Which coin should one include into a basket? What is the weighting methodology? How often should one rebalance? From universe selection to regulatory compliance to market structure and liquidity, many factors can shape the outcome of investments in this sector. A strict adherence to market cap weighting may lead to an overconcentrated portfolio mostly in BTC and ETH and limit the exposure to altcoins, potentially affecting portfolio diversification. An alternative approach addresses the issues highlighted above by implementing a smart beta allocation based on risk parity plus market cap aimed at increasing the exposure to altcoins in a systematic and controlled manner. Other factor-weighted methodologies may show similarly promising results for long-term buy-and-hold investments. When allocating to cryptocurrencies, it is worthwhile going beyond the simple question of position sizing but thinking of diversification, coin selection, rebalancing frequency, and weighting methodology. Gregory Mall, Head of Investment Solutions, AMINA Bank. What are crypto-earned products and how to classify them? Centralized solutions typically implement simple staking or trading strategies, whereas the latter group apply mechanisms like lending, liquid staking, and liquidity provision underneath. Investors tend to leverage earned products due to their ease of use, simple tutorials, and automated fund management. Centralized options are popular due to straightforward compliance and simpler user experience, whereas decentralized alternatives often outpace CeFi in terms of innovation, flexibility, transparency, and rewards. The inherent advantage of the market is its 24/7 availability. Users can deposit and withdraw their assets whenever they want. What framework should I follow when choosing an earned product for my assets? On the flip side, the DeFi scene is spicier with a variety of application types catering to users' investment preferences and risk tolerances. Following the rules of nature, the higher the potential returns, the higher the risks. The major categories with some leaders are services and startup, DeFi Saver, Yield Pendle, Convex, Yield Aggregators, Yearn, Sommelier, Indexes, Enzyme, Origin, and Leverage Farming, Delta Prime, Gearbox. A framework for picking the platform should include an assessment of the following: historical track record, the amount of assets managed, i.e. total value locked, TVL, the background of the team operating at maximal reward or maximal leverage, the underlying yield mechanism. What to expect in the yield sector this year and beyond. Marcin Kazmierczak, co-founder and COO, Redstone Oracles. Keep reading. BlackRock's newly launched spot Bitcoin ETF has become one of the top 5 exchange-traded funds in 2024. Statista forecasts that the global digital asset market revenue will be over $80 billion in 2024. MicroStrategy calls itself a Bitcoin development company and now holds close to 190k Bitcoins.